This is the ERP Advisor.
Today's episode, ERP compliance requirements to go public.
Thank you everyone for joining us for today's webinar, ERP compliance requirements to go public. Shawn Windle is our speaker for today. Shawn is the founder and managing principal of ERP Advisors Group based in Denver, Colorado. Shawn has over 20 years of experience in the enterprise software industry, helping hundreds of clients across many industries with selecting and implementing a wide variety of enterprise solutions. His podcast, the ERP Advisor, has dozens of episodes with thousands of downloads and is featured on prominent podcast platforms such as Apple and Spotify. On today's call, Shawn will provide the playbook on utilizing ERP to go public. Welcome, Shawn. Thanks so much for joining me today.
You bet. Always good to see you.
Yes, good to see you. I like your background.
Yeah, it's a kind of a rainy day in Florida, on the West Coast today.
It looks great. So, well, today is we're going to cover kind of a bigger topic about companies that decide to go public, and the process leading to a company's IPO can be tedious, especially as it relates to the financial reporting compliance requirements that are involved. So with that, Shawn, can you talk to us a little bit about what does a business need from its ERP in order to go public?
Yeah, it's a great question, and it is I don't know. I was about to say it's a complex topic,
yeah,
but actually it's not. It's actually quite straightforward. And I think, as usual, Juliet, that's why we love doing our seminars, is to help sort of dispel fears, anxieties, craziness around ERP, which is just a wild area. There's a lot of misunderstandings in this space. So I completely and totally decided to change my approach in that 1 second. So here we go.
Okay.
Basically, if you think about a company, right, going through the process of getting funds from the public, doing a fundraising effort to get money, and a lot of money from a lot of people, right? There, of course, unfortunately, have been abuses of that in the past, where a company has said, oh, yes, our sales are $500 million, right, Enron? And in actuality, the sales were a lot less, like significantly less, right? Or maybe their cost structure was more than what they reported. Maybe their profitability was less than what they reported. And so, Joe and Jane investor are going to look at a prospectus, it's called, that says, here's the information about this company, and we're going to make a decision about it. Are we going to put our money into it or not? Now, it's really more like the investment bankers, the investment community, right? Sort of the organization. Institutional investors are who's usually buying most of the shares of an IPO, of an initial public offering. So these folks are super savvy, right? They're wicked, crazy, wild savvy financially. But even if they're getting false information about the organization that wants to go public, and they make an investment decision based off, wow, they make so much money and their projections are really high, I want to buy this stock when it's first offered, and I'm going to hold it because it's going to be worth a bunch later, and I'm going to sell it and make a bunch of money, right? That's basically what the idea of the IPO is from an investor standpoint, very simplistically. But what if the financial statements are materially misstated, or even immaterially misstated, right? And you have to say, well, where do the financial statements come from, right? And those financial statements usually come from an ERP. Oftentimes, an organization will use America and really the world's favorite ERP called Excel for financial statement reporting. But there are a lot of financial statement best of breed tools out there too that you can create reports in. But ultimately, that's the topic that we're really going to kind of hone in on today is, fraud is fraud. There ain't no way to get around it. Like, if somebody's putting numbers out that are fraudulent, you could have the best systems in the world and there's still ways to get around it. But the reality is a good solid ERP in place can help you reduce the risk, or even the perceived risk, about there being issues with financial statements, internal controls, and kind of around financial reporting. So, it's it's a tricky subject, right? But we need to keep it simple for folks, for me even, to understand this, right? Because when we're talking to clients, they're talking to the big four, the big three, big 10 accounting firms, like, okay, we got to go do all this stuff, blah, blah, blah. But there isn't really like a regulation or a policy that says your ERP has to be set up this way in order to go public. It doesn't really exist. There's a couple frameworks that we'll talk about.
Mhm.
There's, of course, the Sarbanes-Oxley with sort of the focus around, again, internal controls around financial reporting. But to say, okay, here's exactly what your system needs to do, it doesn't exist. So we'll talk about what some of those best practices are for sure. Try to break it down and keep it simple.
Okay, well, this sounds good. Well, you did touch on SOX. And so what is SOX compliance and how does it relate to ERP?
Well, again, a great question. And I actually have to go back and just check on my own kind of memory banks here. Well, again, I have a better idea. So as some of you know, I was at a small accounting firm called Arthur Andersen in the late 90s. I actually left and went to JD Edwards before the implosion of Arthur Andersen. We just did a whole alumni program, and it was super cool because hundreds and hundreds of people put out their success stories from working at Arthur Andersen. They're probably 99.9% of the people at that firm were great, but there was a group that was doing things that were very, very risky. And that one group basically caused this entire firm to just literally get shut down. Like that had never happened before in the history of US business, where an institution, Arthur Andersen, was shut down. And basically from my own observations, what I saw, because I worked for a partner who had a senior partner over him that sort of oversaw the Southwest region communications and energy practices for Arthur Andersen, which would have included Level 3, Enron, some of those other clients that were
the big names.
Yeah, they were kind of cooking the books, right? And so there you go. And so I really had this intimate view, but I was still way away from what was really happening, right? I was in the business consulting practice, but as I kind of saw it, I think Arthur Andersen as a firm was pretty aggressive at that time about how to recognize revenue, right? There were some trades and some other things that I think Enron had some assets that were kind of off the books that should have been included in there, but they weren't, and some other stuff like that. So we know all that stuff. Unfortunately, that sort of aggressive approach from auditing firms that's not the first time that happened, right? With Arthur Andersen. It's just at that time, the Security Exchange Commission, again, from my perspective, sort of said, hey, we need to make an example out of this situation. And they wanted a throat to choke, right? Because Enron did go public, the stock went way down. A lot of people lost a lot of money. And that's where I think Arthur Andersen was like, bing, right in the crosshairs of like, we're going after these guys. And they did. And like I said, they shut down the firm. But along the way, I think it was about 2002, there was an act that Congress passed by a couple congressmen. Sarbanes was the name of one of them, and the other one's name was Oxley. So Sarbanes-Oxley, and often you'll hear SOX, S-O-X. It's a shortening or just an abbreviation for that act that Congress passed back in the early 2000s that basically put more controls in for financial reporting for public companies. So it's not really applicable to private companies. Actually, it's not. But because there's a lot of investment from private equity and venture capitals and other kinds of investments, the private companies also are using the Sarbanes-Oxley framework to say, okay, we need to have some of these controls in place as well, just to make sure that we're not just giving the perception that we're doing the right thing for financial statements, but that we really are. But the big thing here, and this was a major, major change, right? And this is probably why people are listening to this call. The chief financial officers and the CEOs with Sarbanes-Oxley have to sign on the dotted line that the financial statements are accurate. And if they're not, they can face criminal charges.
Oh boy. Yeah.
Oh boy.
So
Right.
when they sign on that dotted line, they better be able to verify all that information is correct, right?
That's right. That's
Right.
right. And if you're in a huge organization or even a small organization, sometimes it's hard to catch fraudulent activities. So how do you prevent the fraud from even occurring in the first place? And those are internal controls, segregation of duties. There's a couple frameworks out there, the COSO, COBIT framework from different organizations that have said, here's the kind of controls that you need to put around your accounting systems so that you're preventing fraud from happening as much as you possibly can, so that when the financial statements come out, we can certify, we can sign them, right, as the officers of the organization, as well as the auditors, knowing that all these controls were put in place. So it's a little bit of a, it's I don't want to say risk reduction. It's more than that, is what companies have to do, looking especially at a public offering. They need to have these controls in place, and then their auditors need to certify. Usually you'll hear like an internal controls audit, where the client hires an auditing firm to come in, usually different than the accounting firm that does their books. Their audits their books. It's a different firm that'll come in and check their internal controls, and that firm will offer suggestions and things to do. And usually, again, around the whole financial statement process. It's not just push the button and here's the balance sheet. No. It's how do we account for cash? How do we account for assets when they're purchased? What do we capitalize? What do we expense? If we capitalize this, what's the depreciation? Where is the asset at? How do we track the asset? How do we know the asset really existed? And in that, Joe Blow AP clerk didn't just go buy their own car and take it, right? So there's a lot of things around that you really get down to the detailed level. And that's what we'll get into in this call, is like some tangible things that folks can do with their ERP before they go through this process.
Well, with that, Shawn, let me ask you, what must an ERP include in order to comply with internal controls?
Okay, first off, Juliet, when you started working with us 8 years ago, was it 8 years?
Oh, gosh, maybe not quite. Maybe
7?
6?
6? I
Maybe.
never would have thought you would have asked me that question.
Me either. Believe me, right?
But it's a great question. Right. So, there's like 5 things that are pretty basic. That again, these are the 5 things. I'm going to name them off, and these are really important for folks to just do on their own, right? No particular order to this, but these are the things that an ERP should include, right? The first one is really good roles and permissions, meaning when you set up a system, you can set up a person, a user, right? And then you have to control what they have access to. We used to call it CRUD back in the day. Create, read, update, delete.
Okay.
But that's crazy to have to do that for every user. Wouldn't it be great if you could just set up a role that was like AP data entry, right? AP clerk is the role, and the role says, oh, well, they can create a vendor bill, but they can't create vendors. So I'll talk about that one in a second, but have that role in place, right? And then you're assigning people to that role. And then you have other roles, right? Where you have maybe another person in the organization that creates the vendors. After they do the approval of the vendors, get the 1099s. I think they're called 1099s, right? Or no, Erica, I wish she was here. She would tell me what the form is. W-2, W-4, that a vendor, I think it's a W-9. What is it?
W-9.
W-9, thank you. W-9, vendor has to fill out a W-9 with us, get their tax ID number. Somebody's setting up the vendors, that's a different role in the system. So you gotta have roles and you gotta have permissions for sure.
Is that so? Let me interrupt. Is that so? Like someone isn't creating a vendor and then having like signing rights, and then they're like maybe writing, different invoices to someone that maybe doesn't exist?
That's exactly right, which we'll get to the second issue. And this stuff happens. It happens.
We know that, right?
Now I'm going to talk about that one on the 5th, on how you know when it's happening. But again, have really strong roles. Do not give all of your users admin access. Please. I don't care if it's QuickBooks to SAP. Don't do that. That's pretty obvious. But yet you'd be surprised especially when you have an early stage startup that's going through multiple phases of funding, and then they're going to go IPO and they're like, oh, everybody has admin access to whatever the financials are. Like, don't do that. That's easy. Do that. Good. Second thing is segregation of duties, which is exactly what you just said there, right? If you can cut a check, you shouldn't be able to create a vendor, right? Don't do that. segregate out the duties. Now, when you're small, sometimes it's hard to do that, but as you get larger, you've got to keep that segregation of duties in mind for sure. You want to segregate out, the person who, again, can create payment or receives payment can't create a customer or a vendor. Basic. It goes more complex, but that's good enough. The third thing is around sort of cash disbursements and cash receipts. So I'm going to get a little bit accountant on everybody here. But if you think about it, every business brings in money and pays out money, right?
Mm-hmm.
So just really understand what those processes are at the basic level, right? Don't have to go through all the craziness, but just watch the process. Do a document, a process document that sort of shows, here's how money goes out of our company. Here's how money comes into the company. And just build that process. Don't have somebody else do it for you. You don't have to pay $1 million to whoever. PwC, I was going to say, but it could be anybody.
Not to mention any names.
Not to mention any names. It could be Deloitte, but don't just do the basic documentation. Oh, but we're a 500 million, we're $1 billion, we're a $5 billion company. I don't care. Somebody in the company's got to take some basic responsibilities for those two processes, right? And just understand them at a minimum. I will guarantee you when they do that, they will see things like, oh my gosh, I can't believe we're doing blah. It happens. It just happens, and fix it, right?
It seems so simple, but it's the entire business, what's coming in and what's going out, right?
I know. It's wild. It really is, but it is simple at this level, right? The fourth thing is around financial statement creation, right? The better that you can create financial statements without touching them and manipulating them, that tells investors that your systems have controls in place where people they're not required to go and manipulate numbers. Now, the reality of that is, we've worked with Fortune 50 companies that are still creating spreadsheet-based P&Ls, profit and loss statement. Like, it happens, right? There's huge applications like Oracle, Enterprise Performance Management, or OneStream, some of these big consolidation financial reporting tools across multiple entities, multiple countries, and all that. There's manipulation that still has to happen, but if you reduce the amount of manual labor involved in creating your financial statements, you're always going to be better off because the system is managing it for you. The fifth thing, right? And again, this is sort of more from the viewpoint of a company that's thinking about doing this going IPO with their ERP, is go talk to the people that are using the application and start asking some questions about controls and just watch their behavior and their response. There's a secret from the auditor, right? I did auditing. I did internal audit for a bank in Stockton in the 90s when I was in college. And I learned so much from the internal auditors at the bank. And so much of what they do is there's different rules and things that they can do when they pull data, do samplings and stuff like that. But the best auditors are really, really good about reading people.
Interesting. Is it because they want to see if people are telling the truth or if people know what they're doing?
Both.
Okay.
Both. Yeah. You hope it's the latter. It's just
Right.
the latter. But sometimes you get that feeling in your gut like, oh my gosh, this person's getting nervous. They're sweating. They're fidgeting. Maybe they don't know what they're doing. If they're a senior person, if they're a veteran kind of person, there might be something else going on. I'm just saying it, and they start getting, rah, 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 rah. Why are you talking to me? And blah, blah, blah. Oh, okay, good. Oh my God, we probably have some fraud.
Right.
So I'm just telling you, it's so much better when an organization who's about to go through basically the equivalent of like, I don't even know what the right medical term is, but like take a scope and put it everywhere around in your body, up and out and through and everything else. Everybody is going to go through and evaluate the heck out of everything that you do before you go public. We had a friend whose company, he actually just got bought. He didn't even go public. And he had to spend over $1 million with one of the auditing firms to just do some basic stuff around one of his systems. Like, it is a ton of money and there's a lot of people crawling around. So find your issues on your own first. And the way you do that is by talking to your peeps that are responsible for financial reporting today. Controller, AP, AR, fixed assets people, your accountants, whatever they are. Just go and talk to them and get the reality of what they're doing, what their life is like, what's happening, what's broken, what's not. And you will learn so much that's so easy to fix on your own. Then when the experts come in, great, it should be, make it hard for them to find stuff. Don't make it easy.
Yes. So Shawn, with that, like, are there certain things that a company doesn't need to do or shouldn't do with their ERP before they go public?
Well, if anybody made it this far in the call and they're going to go public and they're like, oh my gosh, I got to get out of QuickBooks because I'm going to go public, right? Or whatever app they're in. Maybe it's an old green screen legacy system. Maybe it's something else. I'm going to say something that'll probably make you feel a little bit better. You don't really have to change your ERP to go public. You just don't. I mean, if you do the things I just said, the very 5 basics. Now, listen, you can't go to, your Deloitte senior partner and say, well, Shawn Windle said we don't have to change, so blah, right? I mean, try it. I don't know. Let me know how it goes. Call me up. Let me know. But I am serious, though, that every organization has risks in their financial reporting systems. Even the guys that are in the cloud, right? There's risks of being in the cloud. Systems go down. So it's the reality, though, is that if you just take the time, which that's the problem, is people are freaking out when they're going through diligence for an IPO. They want to get things done fast. Okay, I'm going to go hire this company and they're going to come in and tell me all my problems. Like it's not really going to work like that, right? They're going to go in and do their homework for sure, but they don't know as much as your key people do who've been around for a while. So you might not have to change your ERP if you're going to go public. I will tell you this. We have had clients where the perception of a smaller end tier 4 ERP, or really just an accounting system, is that it doesn't have segregation of duties. It doesn't have controls. It doesn't have approvals on journal entries before they go in the system. You can't even lock a month, can't even close a month and keep it closed without security, right? There's systems like QuickBooks, frankly, that are out there that's the case, right? But I know of companies that have gone public with older systems that you could do those things with too. So if you have documented controls and procedures in place to mitigate those risks, it doesn't just have to be an ERP. I will tell you though, if you're going public and you're in an old system, it might be a good time to think about changing anyway, because you're about to get a boatload of cash, right? And, even if you need to support more zeros, we have a client like that recently where their system doesn't support the level of zeros that they're now transacting in.
Right.
Kind of funny. But it's like, right, you kind of are like a big boy, big girl now. So what are you going to do? Like, you're going to continue to run your business in this, like, 4th tier little application like Sage 50 or QuickBooks or whatever, right? I'm just going to say them. It probably is time to look at a change anyway, because of growth. You're getting into different businesses, adjacent kinds of services that you don't do today, blah, 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 all the normal stuff we talk about in our other calls. But it is important to know you don't have to really change if you have the right procedures in place.
Well, Shawn, let me ask you, you say that you don't have to change, but say a company, is it worth their investment in a more sophisticated ERP to be more attractive to an investor? Or is it almost like, not remodeling your house before you put it on the market so someone can come in and do with it what they want to do with it? Like what's better in that respect, in your opinion?
I mean, it depends, right? I had an accounting professor, Mr. Wheeler, back at UOP, who always used to say, the right answer is always, it depends, but you better tell me what it depends on, or I'm going to give you a 0. It really does depend. So like, if you're looking at investors, like let's say even a private equity or some kind of institutional investor money direct, where we're not going public. I'll talk about that in a minute. But in those instances, they may say, I don't want you to change. I don't want you to remodel the house because I'm going to do it for you, right? But usually when a company is going public, they've decided to continue on their own trajectory, right? They're going to get a ton of money so that they can invest in their operations, marketing, sales, everything, and even back office. So that might be the time where they do now have the funds to hire people, to pay for more software or whatever. So they may use the IPO to change out the software. Typically what you see is that organizations do go through a changeover. We just had a client a couple of years ago that went through a SPAC. And they did go through this change because they knew they were going to do something on the institutional level. And they did want to get out of QuickBooks and Fishbowl, it was called, for inventory. They wanted systems that were more robust in the security and the controls. Not to say those systems can't be, but there is a perception for sure in the investor community that, hey, they're on a better system, so there's less risk. But I'm here to tell you that doesn't necessarily mean that's true, right? If you don't do the things I said earlier, well, you know, you can have the best system in the world, but if everybody has admin rights, then it's crazy. But there is a perception that you can't not ignore for sure.
Right. So if a company invested in a new ERP system, would they tend to get more money on the back end?
Great question. Sometimes, right?
Right.
It's again, it's sort of like everything in life where that investment is speculative, right? Here's what's going to happen in the future. Like we've had clients that have invested in new systems and they've expected organic growth, or they're going to get acquired. And so they want a platform, and they're going to do it now because it's easier than in the future when they get more complex, right? Whether it's IPO or some other kind of liquidity event, like it makes sense. But we've had other clients that go through a big transaction, or they go through a big ERP implementation and they get their system set, and then something else happens. And the parent company says, oh, we're on blah, so now you're going to be on blah. And you're like,
right.
Oh, there goes that system out the window. It can happen, right? So you have to look at the short-term ROI, right? The return on investment for ERP, no matter what. If you're looking at a multi-year, 3 to 5 year frame window, if you will, of getting the ROI, it becomes more risky in doing it in today's environment because stuff's changing all the time.
That's right. Technology is updating daily, right?
Oh, technology, but also, like, you know, there's so much consolidation that PE is doing with mid-sized companies, you know, oh, we're all going to SPAC, and then the SPAC vehicle gets shut down, and who knows what the next thing's going to be. So, you know, like we're talking to several pre-IPO companies right now, and we're really helping them understand, like, is this really worth doing, right? And if it is, then do it right, do the minimum viable product. We've talked about that a bunch of times. Don't do all the bells and whistles and everything else. Get your financials in place, get your internal controls, segregation of duties, your AP approval workflow, even your journal entry approvals, documentation, all the stuff that you need for when an auditor comes in and says, hey, are you doing the basics? Have it in place. And sometimes, again, a new system's a great opportunity to implement those new procedures. That often works too.
Yeah. So, Shawn, what does segregation of duties mean, and why is it important in this case?
Yeah. Well, like we talked about earlier, the person who creates a vendor should not be cutting checks. Right. That's it.
Right. As simple as that. Right?
Simple as that. There's other examples, but you know, you don't have to be a savvy, you know, certified internal auditor to find out where segregation of duty issues are. You just need to sort of look like a reasonable person and say, is it right that the person who creates the bank statements and is working with the bank is also depositing the checks, who's also creating the vendors, right? Could they create their own vendor? Could they create a check and pay that vendor? Now we got them doing the bank and the bank recon, and they pull something out. Don't do that.
Makes sense. Makes sense. So what impact does material deficiency have on companies going public? Can you talk to us a little bit about that?
Yeah, that's actually a big deal. If you think about it, oh, good old accounting. You know, accounting isn't always accurate. There's a lot of times, like if you look at cost of goods sold, even in a manufacturer, where they have standard costs that they're using to generate kind of the profitability on an item. So let me think about the best way to explain this. You think, again, that when you're tracking accounting in an accounting system, like debits and credits just happen. Like you create a sale, customer, you know, you send an invoice, the customer pays the invoice, the end. The accounting entries, the debits and credits are very straightforward. The accounting system puts that in, everything's fine, no problem, right? There's no deficiency and materiality of errors there because it's all 100% accurate. But when you get into other areas, like I was about to go into with cost of goods sold, we can track what our actual costs are eventually, right? Like when we get all the vendor invoices, we know how much we spent on overhead. We know how much we spent on labor, through payroll. We know how much we spent on materials because we get all those invoices eventually. But what about right now? We didn't get all those invoices this month. They're going to come 3 months down the road sometimes.
Right.
What did we report our cost of goods sold at? Well, we kind of had to estimate, right?
That's where you have to manipulate the data, right?
That's right. You have to manipulate what your standard costs are. And so there can be some deficiencies there in terms of, did we say costs were too much? Did we say costs were too little? Oh, that doesn't matter that much, except in times like now when delivery charges are super wicked high, right?
Right.
And we get a lot of materials from around the world. Well, the cost just went up, 5x, right? I think they're kind of going down now finally, but God only knows what'll happen here. We got another election coming up. Great. Who knows, right? So there's deficiencies then in our reporting, and we need to keep them immaterial, meaning it's a percent usually, I think, of revenue, maybe a 2%, 1%. The auditors out there will know what those percents are. But we need to stay within underneath those tolerance levels. That's what that basically means. So that's an area in systems where you have to watch out for sure, is that COGS calculations.
Where it's not real-time data, you have to estimate, right?
Right.
Yes. So Shawn, what is the most practical ERP advice for businesses looking to go public?
Let's see. The most practical, I of course want to say, just get a blank check out.
Right.
I hate to say that, but I mean, the most practical is find your errors, your risks, your internal controls deficiencies on your own.
Right.
It will save you so much money later. That again, it's like going to an attorney to review a document. They're going to have review points because they're getting paid to do that. The internal auditors that you hire, or even the financial statement auditors, external auditors that you hire, they're going to find things,
something,
and you kind of want them to. I mean, not a lot, but a little, just to see if they actually did their job.
right?
If the interns that they hired knew what they were doing. No offense, but the more that you and your organization can handle internally and get cleaned up, and even just those 5 basic areas that I mentioned earlier, it's going to set you up so much better so that your ERP, when these other organizations come in, and they don't only lift the hood, right? I mean, they start pulling the engine out and looking at, okay, where did this, $300,000 check wasn't approved and it got paid? Oh, well, guess what? It was approved. We just didn't put the A or the status on it wasn't approved in our system because it was a manual process to get the approval. It was a bunch of emails, or somebody took the PDF, AP took the PDF and, put it in somebody's desk, or they emailed it over to somebody. And then they got the email back saying approved. And then the AP person forgot to put the email in the system that said approved, a copy of the freaking email, and they paid it, right? That's the kind of stupid stuff that you want to stop or really handle as much as you can based on materiality. Again, if it's a $300,000 invoice, fix it. If it's a $30 invoice, whatever.
Right.
But really think like you would as an investor of your organization. You know it better. Take the time to get it set up. Again, don't just hire some of the firms out there that do these internal audit stuff. I mean, they're great, but that's a lot of prescribed stuff that they're doing. Find a real person that can just be like, yeah, here, I'm going to help you. I'm going to dig around and find all your problems for you. I mean, it's the same thing with cybersecurity.
Right.
That you want to have somebody that can go in and test all your stuff before somebody actually finds the weaknesses, the vulnerabilities. Same thing. Just do it. Just, even if it's like everybody for the day, just stop business. And for one day, everybody has to look around and say, okay, where's the weaknesses in our organization from an internal controls perspective? Maybe it's a couple hours. Write them up in an email and send them off. Oh my God, now there's emails with all of our internal control risks, and the auditors are going to find that, and we got to fix it. Okay, fine. Have people put it in paper and give you the paper and burn the paper later. That's what Enron was doing, was paper into the shredder. I don't know how you want to do it, but and I'm a pretty simple guy, right? I'm not like the big 4 guys out there that are making a couple $1 million banging the COSO and the COBIT and the SOX drum. And it's funny how all that stuff came in after Arthur Andersen went down. So the accountants now make more money from accounting firm being shut down. It's kind of interesting, but there's a little something in that. But I'm just saying, be practical about your internal controls and build as many controls as you can into your systems, into your ERP. If your current ERP can't do things like lock down prior months, okay, might be time to look for something new, right? But maybe you shove all the data into a corporate performance management tool where you can lock the data down, right? And you can bring over trial balance so you have some details for auditors. Right? Be practical about the approach. Don't just take some theoretical, go hire a huge firm that's going to take care of you approach. That won't work. You'll probably pay 5 times more than if you actually did the work up front. I mean, that's kind of how life is. But that's my big message is take the responsibility as early as you can. Easy for me to say, right? My organization's not going through an IPO. But because you're trying to grow and do all these other things at the same time. I mean, I know it's hard, but I know there's people in the organization, maybe it's 2 or 3 people that you put together, maybe they go do that on your behalf, right? To just go see what's going on. That's my biggest advice to folks.
Right. Well, Shawn, thank you as always for sharing your experience and knowledge with me. I appreciate it.
You bet. Juliet, you were like the most informed ERP person on the world. It's great.
Absolutely. Non-technical ERP person, for sure.
Thank you. Always a pleasure.
Yeah. Thanks, Shawn. All right. Thank you, everyone, for joining us for today's call. Please let us know if you have any questions. We're happy to help in any way we can. Call us, email us, whatever. We're happy to help. Be sure to join us for our next webinar scheduled for Thursday, October 6th. When we will be offering a free CPE event. Should I stay or should I go? Knowing when to move on from your legacy ERP. Shawn will confront the benefits and pitfalls of replacing legacy ERP systems. Please go to our website, erpadvisorsgroup.com, for more details and to register. ERP Advisors Group is one of the country's top independent enterprise software advisory firms. ERP Advisors Group advises mid to large-sized businesses on selecting and implementing business applications from enterprise resource planning, customer relationship management, human capital management, business intelligence, and other enterprise applications, which equates to millions of dollars in software deals each year across many industries. This has been the ERP Advisor. Thank you again for joining us.